Hey, welcome back, everybody. And it is, yes, another beautiful day. So here's the thing. We're seeing mortgage interest rates trickle down. And I do mean trickle. That means a little bit. That's like a little. And but it just means that we're not done yet. That's all that means. We're probably going to head back up. We're still in the sevens. We're going to hit some of the low sixes. We're going to go through some of that. Going to recommend the video, 5 questions you should ask when getting quoted mortgage rates. Why? Because it is super, super important. We're going to go briefly, and I do mean briefly, about that. All right. Now, with that, we also are hearing some news that, well, because we had some higher than expected inflation based on CPI, employment numbers, well, those were doing something crazy. Now we have another report that came out on Tuesday that said, the market's doing better than expected. And so the feds are realizing, holy crap, we spent too much money and now we're trying to rein in inflation when everything just keeps going. So we're going to talk about that. We're going to go through a few things. Let's get the show on the road. So first, let's pull this over. There we go. Let's talk a little bit about the feds and the disappearing rate cuts. What does this mean for you? And what is this going to mean for, basically mortgages moving forward? Well, the good news is the feds only affect car loans, HELOCs, credit cards, what banks lend to each other on a daily basis, but they can affect mortgage rates. Okay. And in fact, many times that the feds raise, many times mortgage rates actually come back down. Watch your 10-year treasury. They freakishly follow each other, although they're not tied together. Watch your mortgage-backed securities. As the mortgage-backed security values go up, mortgage rates come down. As more, bonds come down, mortgage rates go back up. So it's one of those things just to keep in mind as you're watching. Feel free to subscribe to the newsletter if you want to get kind of an every Friday feel of what is going on. No, I am not a mortgage broker. I am a real estate broker, designated broker. And the key here is keeping you informed as to how to best navigate this. Now, moving on, if we take a look at our top headline. So as we blow this bad boy up, we can see that even though mortgage rates have been on a higher level, the mortgage apps actually have been increasing, which is super interesting because a lot of folks are taking a look at and seeing that, hey, we're starting to see a little bit of normalcy. Okay, yeah, we're going to see 6.5 to 7.25 normal rates. That's normal anyway, but people are acclimating to it. And so they are starting to make some adjustments. On the right-hand side, you can see in red, hey, you know what? Rates went up into the sevens again. Not unexpected. Didn't quite expect it to go as high as it did, but, we did expect it to bobble. It will come back down again. Take a look at this one. This one's super interesting. So residential construction, and we're going to get into that in just a little bit. They're saying that on a nationwide level, things are flattening out a little bit. We're seeing some of that, even though we're seeing some of, a pullback on inventory from March. However, year over year, we're up like 17% as far as actual inventory on a national level. Locally, we're up a little bit, but not a whole heck of a lot. And we're still seeing a lot of incentives, which is really good. In fact, if you're looking for incentives now, builders are offering probably some of the best incentives for new construction in the mid fives with different alternatives. Make sure the broker that you are working with absolutely understands new construction. It is a unique beast, and make sure they understand so you get the best programs possible because, well, naturally, builders aren't going to negotiate against themselves. Why should they? So they will absolutely capitalize on lesser agents. Make sure you're dealing with an agent that fully understands and how to get you better benefits, because price is not one of them. That is pretty much a non-negotiable thing. There are other ways to get dollars in your pocket. My sermon is over. Moving on. All right. Now, let's take a look at this. We talk about rates and we talk about making sure that you focus on them. Let's blow this bad boy up. Look, we have rates right now, which is kind of a par pricing from bank rate. And, they're saying just exactly what we did. Hey, about 7.25-ish. And people are like, hey, how come a 15-year is less than a 30-year? It's based on risk. Remember that. Rates are based on risk. So the better the credit score you have, the lower the rate because you're a lower risk. If you have a lower credit score, your rates are going to be higher. So make sure that you're asking those real key questions as you're moving forward. As an example, let's blow this one up. I highlighted something that is super important. People look at this and go, oh my gosh, look at that. That is an amazing rate. That's like 6.99. Oh, but wait a second. In yellow, oh, I can only have a $625,000 purchase. Our median price just in Snow King and Pierce County is like $780,000. So that puts you out right there. Plus you have to put 25% down. Well, okay. So your loan balance can only be $468,750. You have to have a minimum of 780 FICO score, and you have to be a single family residence, and you have to be in King County. Well, if you're just looking at the 6.99 and you're looking at, buying something that is either a jumbo or maybe in the $800,000 price point, you don't qualify. That loan program doesn't qualify for you. And you need to know that, as this is called marketing. And don't get caught in marketing, or you will get down to the closing table and you're going to go, whoa, what is this? Okay, what changed here? And you're going to be under a mind perception of one thing and the reality perception many times of something else. Now, yes, there are what we call good faith estimates. They used to be called good faith estimates. I think they're just loan estimates now. And they go through them, but sometimes they pull out some fees or they won't put in taxes and insurance to make it look better. Okay, be mindful. It's a free video. There's no selling. Make sure you watch it. All right, moving on. Look at that Freddie. Let's blow up Freddie here. Not in the literal sense, but let's have a little fun. So Freddie, they're lagging at about 7.1, but they're probably pretty close to actual. And even though, as you saw there, that the rates are actually, they've been heading up for, the last 3 weeks, unless you've been living in a cave, that rates have been heading up. But that hasn't stopped a lot of the real estate and what's going on. So let's take and delve into our consistent every single week metrics, residential only, right? All right, so let's pop this one open. And here we go. Retail sales jumped 0.7% in March, much more than expected. It was the second straight monthly increase, another sign of a resilient company. Stronger data means fewer rate cuts. Powell went as far as saying, hey, you know what? We're probably not going to cut rates anytime soon. We're hinting maybe we'll raise them up, but maybe not. All right, so that's super important, but let's pop into the MLS. So the first time since October of 23, we have seen more homes coming on market at 1,433 versus what went pending, which is 1,348. Super, super interesting, right? Not unexpected. It is considered one of the hottest weeks to list your home. And in fact, they advertise it as such. It's one of the hottest weeks to list your house this week and next week. Why? Highest probability of selling. Why? Because it's the spring market. It's sunny, it's beautiful outside, flowers are in bloom, cats and dogs getting along, who knows? Either way, they say, statistically speaking, it's the best time to come on market because you're going to get the greatest number of eyeballs. Remember, if you overprice your home, you're not going to get eyeballs on your property. You're going to get what's called crickets. And that's exactly what it's going to sound like, where everybody else is going off market and you're hearing about homes going off market in 7 days. Because if your home is well priced, because buyers are super, super smart. They have lots of areas to get metrics. Do not fall in the trap of sentimental equity because there's no value to sentimental equity. I'm just saying. All right, moving on. So as we take a look at our next chart here, before we get that, again, if you're interested in only super accurate information in the Puget Sound, hey, like the video, subscribe, let us know what you think, ask questions. More importantly, like it, tell YouTube, yeah, this guy's okay. He's an all right kind of guy. All right, let's blow this up. Here is what is super important. Now, when we take a look at this, and we take a look at what is the average for sale, green, the average sold, red, which is the upper line and lower line. In fact, let's just blow that up one more time. We can see that we're still heading in a positive trend, not only month over month, 2023 over 2024, or I guess 2024 over 2023, we're up 11.4% just for the month of April, month to date. Year to date, we're up 10%, but yet our average active for sale price is still down just a little bit. Not uncommon, and we've been writing about that 3.3% for quite a while. The reason that is important, that lets you have an idea of trend, because we are still seeing sold prices aggressively. Well, I shouldn't say grow. It is kind of aggressively. It's 10% year over year, month over month, going up. Okay, even though we're seeing a little bit of softening on pricing. All right, but it's a good metric to keep in mind as you're considering and doing things. So when we take a look at the actual numbers, let's blow this bad boy up for you. In fact, let's make that a little bit bigger for you. Okay, let's take a look at this. So we are up 10.9%. And that might seem like a really big number. Well, it's less than 800 homes throughout the Northwest MLS. Anyway, so that's a small, piddly little number, but it looks big because we're dealing with smaller numbers. But look at this. Our sales are only off 2.4%. Pendants are up 1.8%. Which is a bigger difference. It's a bigger number. And when we take a look at it month over month for the month of April for 2024 over 2023, if you take a look at the active, you think, holy macro, man, you had 42.5% more homes come on the market. And we had a 19% increase in pendant and 13% increase in solds. And you might say, wow, okay, last April was horrid. Why? Because that's when we saw all those interest rates going up and everybody started pulling back. Everybody is acclimating. We still have a limited inventory. Heck, we only have half of the inventory that we should normally have pre-pandemic. So we're still struggling. We're at like 1.7, 1.8 months of inventory, when technically 4 to 6 months, really, since 2013, probably 2.5, 3.5 months of inventory is average. Just saying, where you have a pretty good balance of buyers and sellers. As you see, we're not drawing it down into the 2000s like in 2020. But then again, the feds aren't buying the rate down into the high 2s, low 3s either. So that's what they were doing before. Anyway, moving on. New construction. Take a look at this. All right. So in new construction, single family homes fell 12.4% for the same month, from over March. But we're 17.4% higher year over year. And that's pretty important. We have seen just a little bit of a slowdown, even though our inventory is up just a tad bit. People are pulling back just a tad, and that is primarily because of rate, because of some of the programs out there. Builders started offering less incentives. And so people, they just weren't as excited about that. And we're going to start to see the vacation trifecta start to happen in the middle of next month. So in about 30 days, we're going to see the vacation trifecta. We're going to start seeing people pull back. People are going to start going on vacations, getting ready for Memorial Day. Yes, Memorial Day. Then we have kids getting out of school or planning for vacation. Summer is nice. You're going to go out and do other things, normal until after July 4th. So remember that if you're a seller, you have 30 days before we start seeing a marked decrease in activity from buyers. Always happens. Keep that in mind. It's not going to be different this year. All right, moving on. If we actually blow those numbers up, you can see them a little bit better. There we go. All right. We have our better numbers there. 3% down on sales, which again is not a whole lot. It's about 70, 80 homes. Pretty much peanuts, right? All right. New construction is still doing well, but let's take a look at bank owned. So I actually went through and I just gave myself the first 40. And of the first 40, yes, some of them actually sold. We have some new ones on, but we actually only have 54 actual REOs or bank-owned homes, and the other, 8 or 6 of them actually are not. It's 8 actually, but notice when you take a look at the new listings and the pending, we're right on target. I'll blow that up for you. Look at this. We're right on target. You know, we're at 102 pending, 133 new on market. Again, when we talk about these numbers, right, these are peanut numbers. These are super small. And there's a lot of folks that are saying, oh my gosh, I think we're still heading to a crash. And hey, listen, we haven't even, I don't even think we have hit 600,000 foreclosures in the United States, when before, the next, least amount was like 1 million, right? And before that, we were like 3 and 4 million. And we are still seeing very, very little. What we are seeing is commercial issues and commercial lending and commercial, banks getting in what we call insolvency, and that is where the biggest fall is. Some of that, when they talk about builders, well, that's where they get their builder financing. You might be seeing some projects out there. There's a few in Renton and up north and in Bellevue where they've stopped. Why? Probably because they lost their funding, because you have to maintain a certain collateral level. Commercial is totally different. And you either have to bring in cash or you have to refinance. You have to do something to maintain your debt to income ratios on a commercial property, plus the refinance. So sometimes it's better for them to hold. So they do. That can be bad. For developers, that's just holding costs, and depending if they can absorb that or not, or if they have to look at alternatives. Anyway, moving on to the important part. Hey, listen, remember to like, subscribe, smash that subscribe button. Have a little bit of fun with it, right? It's a beautiful day out there. Enjoy it. We're going to have a couple of days of rain and some beautiful weather back again. If you have any questions, put it down below. We will normally get back to you in about 30 minutes. In the meantime, all the best to you and your family. I will see you on the next video. Take care.